Welcome to the complete and concise forex trading course by PIPSDIMENSION. This course is fully packed and well organized from beginner lessons to intermediate lessons to advanced lessons. And so you get a smooth learning process to become a consistently profitable forex trader at the end of this course, even if you are starting as a complete beginner. The lessons are brief and yet they are loaded with all the essential contents that you need to get you started trading. On this note, I'd like to highlight the topics you are going to learn at every stage of this course. Stage 1 covers content on the general knowledge about the introduction to forex trading, what is traded in the forex market, and how forex trading occurs. You also learn about currencies and the currency pairs. You learn about trading times and sessions. Learn about the advantages of forex trading. Trading orders explains when and how to buy or sell a currency pair. Trading terminologies. Trading analysis, fundamental and the technical analysis. You also learn about the trading styles, that is scalping, day trading, swing trading, and position trading. Then you learn about risk management or the money management. Then we move to the intermediate lessons of stage 2. This stage involves practical lessons about the trading platform interface. Here you know about the general features of the MetaTrader 4 and how to use the MetaTrader 4 to execute trades. And on the price chart of the trading platform, you shall learn about how to identify some useful chart patterns like the trend and waves, the channels, support and resistance, wedges, head and shoulder patterns. Then you learn about how to identify some useful candlestick patterns, how to use the Fibonacci tool, and then you learn about some useful indicators. In stage 3, we shall master how to use the chart and candlestick patterns to make profitable trades using the price action. And then you learn how to develop a profitable trading strategy. Here you learn about some scalping strategies, day trading strategies, and some swing trading strategies. After that, I'm going to be talking about the trading psychology. Trading psychology makes a very big part of your success in forex trading. In addition, you can have a time with some expert traders at PIPSDIMENSION to mentor you on the psychology to become a consistently profitable forex trader. So in a nutshell, at the end of this complete forex trading course, you shall acquire the necessary knowledge in forex and open a trading account with a recommended forex broker. You shall know how to use the trading platform to make trading analysis and make trading orders, and be able to develop trading strategies to make consistent profits in the forex market. Now, forex trading is a very rewarding skill to acquire. Yes, as a profitable forex trader, you can be trading with your own money and be making significant amount of profit. Yeah, on a weekly average, some traders are making over 1 up to 100% or even over 100% profits on their trading capital. So high or low profits is dependent on the rules you apply in your risk management plan. Moreover, you can apply the technical skills in forex trading into trading other commodities such as cryptocurrencies, stocks, indices, energies, metals, among others. So with the forex trading skill, you are like your own investment firm on your computer or your smartphone. But to become a profitable forex trader does not happen overnight. Yeah, just as is required to become successful in any other business venture, you need to be patient enough to learn and acquire the necessary knowledge. And the next is to practice continuously. Experience is something that is developed by continuous practice. So for a beginner, it is advisable to make use of the demo account offered by forex brokers to practice trading long enough to have confidence in your skill set. Better still, at the initial stages of trading with your real account, it is advisable to reduce risks by trading with the least amount of volumes possible. With that said, let us start with the beginner stage of this course. My name is Kwame Arthur. You can also call me Osanaaba Kwame Currency. Since trading is about buying or selling of products, most newbies get really confused when they are introduced into the online forex trading because probably they don't see any physical products that are being bought or sold. This takes us to the next question: what is traded in the forex markets? Currencies such as the US dollars, Canadian dollars, the Great British pounds, the euros, the Japanese yen, the Turkish naira, the Czech koruna. Okay, special currencies like this are what we trade in the forex markets. Let us start with the meaning of forex. Forex or FX is a short term for foreign exchange, the exchange of one currency for another currency. If you think of transactions that makes up the forex market, it's enormous. There are plenty transactions that requires the exchange of one currency for another currency. For example, if you are in Africa and you want to purchase something from the United States, you have to convert your local currency into the US dollars before you can successfully make that purchase. Also, maybe you want to go on international vacation, you realize for every country that you get into, you have to convert your local currency to that country's currency before you can survive in their economy. Think on a large economic base. The importation and exportation between two countries requires the exchange of one currency for another currency. You see, these and other transactions that requires the exchange of one currency for another are basically what makes up the forex market. It's huge as a matter of fact. The forex market generates an average daily trading volume of over 5 trillion US dollars. For you to understand how you can trade with currencies to make profits, let's look at a live instance. For instance, if you have 1,000 US dollars with you and you decide to exchange this 1,000 US dollars into the Great British pounds, you have to go to a forex bureau or a bank. You go there to find out that the exchange rate is giving us 1 Great British pound is to 1.35 US dollars. With this rate, when you exchange your 1,000 US dollars, you go back home with only 740.74 Great British pounds. Now you hold these pounds for some time, like some few days, after you decide to exchange your Great British pounds back into the US dollars. So this time, upon getting to the bank, you realize there has been a new exchange rate. Let's say now 1 Great British pounds will give you 1.56 US dollars. With this new rate, when you exchange your 740.74 Great British pounds back into the US dollars, you will have 1,155 US dollars and 55 cents. So when you compare this to the initial 1,000 US dollars, you'll realize you've made $155 and 55 cents as profit. So basically, this is what we do in the forex market. We make speculations about the exchange rate between two currencies. With that, we either buy one currency against another or we sell one currency against another. And if our prediction goes in the right direction, we make some profit. This of some international economic and technical analysis. With online forex trading, all these activities can be carried out on a trading platform right on your PC or your smartphone. And that means you can partake in this large forex market wherever you are around the globe. To make significant trades in the market requires a significant amount of capital. That is why the major participants in the markets are the large corporations, institutions, and some few rich people. But forex brokers have made forex trading easily accessible to retail traders. Forex broker is a financial institution that serves as an intermediary between the forex market and retail traders. With a forex broker, You can open a trading account through which you can make your deposits and withdraw your funds. They provide you with a trading platform on which you can perform your trading analysis and make your orders. Also, they offer you a leverage to maximize your ladder capital in the market. For example, a leverage of 1:10 means the brokers will allow you to trade within a volume that is 10 times your actual capital. And they'll give you some technical support like some instruments and tools that you need for your trading. Based on their operations, Forex brokers are categorized into the ECN brokers, the STP brokers, and the market makers. The ECN brokers execute your orders and they charge some little commissions on your trades. But the market makers usually make money by using the spread, the difference between the bid price and the ask price. There are a lot of Forex brokers in the market. However, it is advisable to register with a highly recommended Forex broker. In Forex, you have the opportunity to trade with a lot of different currencies in the world. You can identify these currencies by a code, by the International Organization for Standardization, that is the ISO code, which is usually in 3 letters. But here in the market, some of the currencies are mostly traded than others. This is probably because these currencies are the mostly used in economic transactions, such as the US dollars, the Great British Pounds, the Euros, Japanese Yen, the Switzerland franc, the Australian dollar, Canadian dollar, and the New Zealand dollar. These are also known as the major currencies. So you can see that the major currencies are those of the developed countries with stable economies. The market also features some currencies of some fast emerging economies, such as the Mexican pesos, the South African rand, Polish zloty, Turkish lira, Chinese yen. Just to mention a few, there are more minor currencies in the market than majors. To make a complete trade requires the simultaneous exchange of one currency for another. That is why the currencies are put in pairs in the Forex market. For example, when you pair the euros with the US dollars, you get the euro-dollar pair. Now, since a lot of economic conditions circulate around these major currencies, most traders find it more convenient to trade with the major currency pairs. A major currency pair is simply a pair of 2 major currencies, more especially when the US dollars is paired with another major currency. For example, the euro dollar, the pound dollar, the Kiwi dollar, the Aussie dollar, the dollar yen, dollar loonie, and the dollar Swiss. A cross-currency pair is a pair of major currencies without the US dollars. Aussie loonie is an example of a cross-major pair. Pound Aussie, the Aussie Kiwi, the Aussie yen, the Euro yen, the Euro loonie, the Euro Aussie, the Pound Aussie, among others. And when a minor currency is paired with another currency, we get a minor currency pair. In most cases, minor currencies are paired with the US dollars. For example, the dollar rand, the dollar pesos, the dollar yen, so on. Now we understand why the currencies are put in pairs. We also understand the major pairs and the minor pairs. Let's look at this example, the GBP USD, the pound dollar. That is quoted as the GBP USD 1.3516. That is a currency pair quotation, simply the stated currency pair with its current price. The first currency of the pair is known as the base currency, meaning that its value is always 1 against the next currency, which is a quote currency. So what this quotation actually means is that 1 Great British pound will give you 1.3516 US dollars. Here are the 4 main sessions that keeps the forex market running 24 hours in a day. The Sydney session is open at the hour of 22 and it closes at the hour of 7 GMT time. The Tokyo session is open at the hour of 23 and closes at 8 GMT. The London session is open at the hour of 7 to 16 GMT. And the New York session is open at the hour of 12 to 21 GMT. So you can make out from the opening and closing times of the 4 main sessions that at least one of the sessions stays open at any time of the day to keep the market running 24 hours. And it stays open for 5 days in a week. And you can also make out from the 4 main sessions that some of the sessions overlaps with others. For example, the Sydney session overlaps with the Tokyo session within the hours of 23 to 7 GMT. The London session also overlaps with the New York session within the hours of 12 to 16 GMT. And the Sydney, Tokyo and London session all overlaps at the hour of 7 GMT. It is important to take notice of these overlapping sessions because 2 or more sessions open increases the number of participants in the market and makes the market more liquid. More liquidity gives traders more trading opportunities, and that really occurs during these overlapping sessions. Trading Forex has uncomparable number of advantages, and this accounts for why it is a large financial market with large number of global participants. First of all, the market stays open 24 hours in 5 continuous days of the week. And this makes it possible to be able to take part in forex trading at any time regardless of your time zone. The instant order executions per the large number of buyers and sellers in the markets causes a lot of price fluctuations in a matter of few seconds to give you more trading opportunities. Therefore, it causes the market to be highly liquid, so you can decide to make a complete trade and see results in a matter of few minutes to hours, or in some days to weeks, in months or years, depending on the type of trade. The leverage offered by forex brokers is uncomparable to other financial markets. Also, the forex market is decentralized, meaning that no individual corporation is in charge of the changes in prices of the currencies, except in a case where a forex broker is not regulated. They may have the opportunity to make manipulations in the prices to their own advantage. That is why it is advisable to register with a highly regulated forex broker. For beginners, to prevent the risk of losing your money, forex brokers offers you with a demo trading account and a trading platform so that you can practice on your strategy for as long as you want to be well equipped with the skill set and to be confident enough with your trading strategy before you can start trading with a real money. And this makes the forex market more flexible because you decide when and how to get in and out of the market. Thus, you decide to either become a full-time forex trader or a part-time forex trader. Alright, now we understand that we take chances to make profits on the changes in the exchange rate of the currency pairs. Forex trading offers you the chance of making profits in either ways, that is, when the price rises or it falls. Yeah, traders stand a chance of making trades in either ways. So the two main orders in forex trading is to either buy a currency pair or sell a currency pair. Traders buy a currency pair when they expect a rise in the current price. In other words, when they expect the base currency to increase in value against the quote currency. And traders sell a currency pair when they expect a fall in the current price. Or you can say traders sell a currency pair when they expect the quote currency to increase in value against the base currency. For example, as a trader, you've made a trading analysis on the Great British Pound US dollar, and maybe you realize the Great British Pound is gonna rise in value against the US dollars. So what you have to do is to place a buy order on the Great British Pound USD pair at maybe 1.12184. That is your entry point. This is a buy order, so you'll be making some profits as the price rises above your entry point, but you'll be making some losses as the price falls below your entry point. On the other hand, maybe you place a sell order on the Great British Pound USD at 1.12184. Well, that is a sell order, so what will happen is you'll be making profits as the price falls below your entry point, and you'll be making losses as the price rises above your entry point. Now, let us look at some specific ways of making buy or sell orders. This explains how specifically you get into the market to make a buy or sell order at a particular price. It explains the most specific ways of setting your order entry point. These are the instant market order and dependent orders. Using the instant market order, we'll instantly buy or sell at the current available market price. Let's look at the two main types of dependent orders. These are the limit orders and the stop orders. Limit orders are either used to set your buy order below the current market price or to set your sell order above the current market price. Thus, you use the buy limit order option when you want to set your entry point at a level that is below the current market price. And then you wait for price to move down and hit your entry level and bounce back up for you to make profits. On the other hand, use the sell limit order when you want to set your entry point at a price level that is above the current market price. And then you wait for price to move up and hit your entry level and bounce back down to make profits. Stop orders are either used to set your buy order at a level that is above the current market price or to set your sell order at a level that is below the current market price. Thus, use the buy stop order when you want to set your entry point at a level that is above the current market price, and then you wait for the price to move up and hit your entry points and continues upwards to make profits. On the other hand, use the sell stop order option when you want to set your entry at a price that is below the current market price, and then You wait for the price to move down and hit your entry and continues downwards for you to make profit. As a trader, you need to understand these basic terminologies to be able to speak in the Forex language. Long and short are the terms used for the two main trading orders. To take a long trade means to buy, and to take a short trade means to sell. These traders are referred to as a bull or a bear. A bull is simply a trader who has taken a long position. A bear is a trader who is in a sell position or a short position. We say a market is bullish when the price is uptrending or going up. And we say a market is bearish when the price is falling. Looking at the next three important terminologies, you find them mostly on a trading platform. That is the bid, the ask, and the spread. This is for currency pairs. You see the pair quoted on a trading platform with the bid price and the ask price. The bid is actually the price at which forex brokers buy when you place a sell order, or simply the price at which you can sell the currency pair. Ask is a price at which a forex broker sells a currency pair when you buy. Or simply put, ask is a price at which you can buy the currency pair. When you look at the bid and the ask price, you can see that you can make out a difference. That is what we call the spread. A spread is the difference between the bid price and the ask price. It is the amount that the forex broker charges you on your trade. In this example, you can see that the difference between the bid price and the ask price is 0.00015. In other terms, it represents 1.5 pips. This is a little amount. The amount you lose by the time you open and close a trade, and that goes to the forex broker. That is the commission they charge you on a trade that you make. Know that a good forex broker is also characterized by the low amount of spread on your trades. You will need huge amount of capital to be able to trade huge amount of volumes. For example, if your trading capital is $1,000, then actually you are supposed to trade within only 1,000 units. For higher volume, that is why the forex brokers offers retail traders a leverage. A leverage is like an amount the forex broker gives to you or borrows you on top of your account. And it is given in ratios. For example, a leverage of 1:100 means your capital is multiplied 100 times. So if you have a capital of $1,000 and you are offered a leverage of 1:100, that means you can trade within a volume of $100,000 of currencies. If you are offered a leverage of 1:1000 and your capital is 1,000, that means you are allowed to trade within the volume of $1 million. Take profits and stop loss targets are levels or price targets at which a trader sets to automatically close the trade in profit or in loss. For a buy order, the take profit target is set above the entry price, whereas the stop loss is set below the entry price. For a sell order, the take profit level is set below the entry price, whilst the stop loss is set above the entry price. The next term we are going to talk about is probably the most popular term in the forex market, pips. That's percentage in points. It is the smallest unit of change in the price of a currency pair. The counting of pips begins on the 4th decimal place of a currency pair quoted price. But most forex brokers end their quotation at the 5th decimal place that is known as the pipet. The pipet is usually written as a subscript or a superscript. Now, for you to understand pips very well, let us look at this instance. If the price of the Great British Pound USD rises from 1.39162 to maybe 1.39186, you can see the difference here is 0.00024, and that represents 2 pips and 4 pipettes. Well, usually we disregard the pipettes. In this case, if a trader bought the pair at 1.39162 and later closed the position at 1.39186, then the trader will be in 2 pips profits. If, on the other hand, a trader sold this pair in this same situation, then the trader will be in 2 pips loss. Or maybe if the price falls from 1.39162 to maybe 1.36249, the difference in this fall will be 0.02913, and this represents 291 pips. So here you can say the pound dollar has fallen by 291 pips. In this instance, a trader who made a short trade will make the 291 pips as profit, but a trader who made a buy trade will make the 291 pips as loss. In the nutshell, 1 pip represents 0.0001 change in the price of a currency pair. 2 pips represents 0.0002 change in the price of a currency pair. 34 pips represents 0.0034 change in the price of a currency pair. However, for the Japanese yen currency pairs, the counting of the pips starts from the 2nd decimal place. If we take the Kiwi yen for example, if the price of the Kiwi yen rises from 138.743 to 139.907, the difference will be 1.164, and that represents 116 pips change. So since the price has increased by 116 pips, the buyers in this instance will make a profit of 116 pips, whereas the sellers will make a loss of 116 pips. If the price of the Kiwi yen falls from 138.743 to maybe 138.673, the difference will be 0.070, and that is 7 pips change. In other words, the Kiwi yen has fallen by 7 pips. And since the price has fallen by 7 pips, sellers in this case makes a profit of 7 pips, but buyers in this case make a loss of 7 pips. So for the Japanese yen pairs, 1 pip represents 0.01 change in the price of a currency pair. 2 pips represent 0.02 change in the price of a currency pair. And 34 pips represent 0.34 change in the price of a currency pair. The value of the pips that you gain or you lose by taking a position on a currency pair is determined by the amount of volume of the base currency that you use for the trade. In Forex, brokers offers you a wide range of volume to choose for every trade that you take, also known as the lot size. So the lot size or the volume determines the value of every pip change in the price of a currency pair when trading. Before you understand how to calculate the value of a pip, let us consider the different types of lot sizes. A standard lot represents 100,000 units. So for example, one standard lot represents 100,000 units. Two standard lots represent 200,000 units. 6 standard lots represent 600,000 units. A mini lot represents 10,000 units. For example, 7 mini lots represent 70,000 units. And we have the micro lot sizes, which represent 1,000 units. For example, 2 micro lots represent 2,000 units. 3 micro lots represent 3,000 units. To calculate the value of a pip, we multiply the lot size by the number of pips changed. Then the amount is converted from the quote currency to the trading currency. That is, if your trading account is in the US dollars, the amount will be converted from the quote currency into the US dollars. For example, if you trade one standard lot of the euro-dollar pair, then the value of one pip will be 100,000 multiplied by 0.0001, and that will be 10 US dollars per pip. If you trade one standard lot on a Japanese yen pair like the Kiwi yen, then the value of one pip will be 100,000 multiplied by 0.01. That will give you 1,000 Japanese yen. And this will be converted into your trading currency. So if your trading currency is in the US dollars, the 1,000 Japanese yen is converted into US dollars. If you trade 2 standard lots on the Canadian dollar Japanese yen pair, then the value of one pip will be 200,000. Remember, this is 2 standard lots multiplied by the number of pips, 0.01 yen, and that will be 2,000 Japanese yen. And again, this 2,000 Japanese yen is converted into your trading currency. If you trade 1 mini lot of the euro-dollar pair, then the value of one pip will be 10,000 multiplied by 0.0001 US dollars, and this will be $1 per pip. If you trade 1 micro lot on the euro-dollar pair, then the value of one pip will be 1,000 multiplied by 0.0001 US dollars, and that will be 0.10 US dollars per pip, or 10 cents per pip. Alright, to understand this better, let us look at the trading example. If a trader buys the Great British Pound Australian dollar at 1.9895 and later closes the position at 2.0067, then he will make 0.0172 Australian dollars as profit. In other words, that is 172 pips. In this case, if he traded with one standard lot, then the value of the 172 pips will be 1,720 Australian dollars. Then this is converted into the trading currency. Or if he traded with 1 mini lot size, then the value of the 172 pips will be 172 Australian dollars. That is 10,000 multiplied by 0.0172. If he traded with a micro lot size, then the value of 172 pips will be 17.2 Australian dollars. Or if he traded with 7 lot size, then the value of the 172 pips will be 700,000 multiplied by 0.0172. That will be 12,040 Australian dollars. And this is converted into the trading currency and added to the trader's account. So you see, two traders can make the same number of pips in profit, but if they use different lot sizes in their trade, they are going to make different amount of profit on top of the account. Since your ability to make profit in the forex market is dependent on making correct analysis between two currencies or between two economies, there are two main analyses that are considered in forex trading, and these are the fundamental analysis and the technical analysis. These two forms of analysis are considered in the forex market to make more correct predictions. When we talk about fundamental analysis, this analysis is based on the international economic news. The economic news such as the employment rates, the interest rates, gross domestic product or GDP, just to mention a few, about a particular country gives a trader an idea as to whether the currency of that country will appreciate in value or depreciate in value. Technical analysis is done on the chart of a currency pair on a trading platform. A trading platform provides several tools like the candlestick patterns, the chart patterns, the indicators, and the objects such as the Fibonacci, trend lines, and others, and they are all used to predict the direction of the next price move. Some traders use only one form to develop a trading strategy, but others combine both the fundamental and technical analysis to create a trading strategy. However, the most important thing is to choose and work with a strategy that works best for you. High liquidity, which causes a lot of price fluctuations in the 24 hours open forex markets, are the most important reason why the forex trading is more flexible for traders. In the sense that traders have the opportunity to choose a type of trading style that suits their lifestyle, especially their emotions and their schedules. There are four main forms of trading. Scalping. This is a form of trading which aims at making few pips in short period by catching quick price moves in the markets. Scalpers execute their orders on the 1 minute to 5 minutes time frames or sometimes 15 minutes time frame, and they target making few pips in few minutes or few hours. This form of trading is more appropriate for traders who are too impatient to wait for too long time before they see results. Scalpers make quick profits in a short time. Day trading targets at making a profit by the close of the day. This form of trading aims at making profits on the market move for the day. Day traders make their trades on the 15 minutes to 1 hour time frames to make some profit within the day. This form of trading is more appropriate for people who are quite patient enough to see the result by the close of the day. Swing trading aims at catching the price move on the 1 hour to 4 hour time frames, and profits are targeted in few days or few weeks. Swing traders are more relaxed compared to the scalpers and day traders. Swing trading requires the use of the daily, weekly, or the monthly time frames to catch the next price move. Swings are usually left to run for weeks, months, or even years, making it more appropriate for the busy bees with huge capitals. Swing traders mostly use fundamental analysis in their trading strategy. Forex trading can be one of the most rewarding skills to acquire on your financial journey. Yet, trading forex is risky. especially for traders who are not knowledgeable and practically prepared enough. Yes, the worst tragedy of blowing all your accounts can occur if you don't have a management plan to reduce your risk. Reducing your risk begins with having a good trading strategy. Then you should follow your management plan strictly. Forex trading is not a gamble, but you can make it look like a gamble if you don't have a designed risk management plan to follow. It will be hard to make consistent profit when you gamble in a forex market. Let's look at some important keys that you must consider in your risk management plan. It will not be prudent to risk losing all your capital in just a single trade. For a good risk management plan, it is appropriate to risk only 1% to 3% of your capital in a single trade. For instance, if your capital is $1,000, you should not risk losing more than $10 to $30 in a single trade. Risking few percentage of your capital in one trade will sustain your account for a very long time, and also it will give you more room for trading opportunities. Also, in order to protect your account, don't leave your trades running without a stop loss target, else you put your whole capital at risk. Sometimes a sudden price fluctuation occurs, especially after the release of some important economic news. Without stop loss or take profit targets, a sudden price fluctuations can cause either a huge losses or huge profits, depending on which direction the price goes. In worst cases, you can even blow your account. So don't leave your trades running without stop loss targets. Another important risk management key to consider is the risk to reward ratio. This is the ratio of your stop loss to your take profit targets. For example, a risk to reward ratio of 1:1 means when you risk losing $10 of your capital in your trade, you also target taking profits at $10. Or a risk to reward ratio of 1:2 means if you risk losing $10 in a single trade, you target to take profits at $20. For a proper risk management plan, your risk ratio should not be greater than your reward ratio. With this, you still stay profitable if your trading strategy gives you more wins than losses.